Welcome to the SmartKeys podcast. We are jumping into a deep dive today, and it's one we've custom tailored for you. The goal is to translate all these confusing macroeconomic signals into, well, a sharp, actionable business strategy for 2026. We're going to be dissecting the latest data, the practical tools, everything that's shaping productivity gains. So if you need a shortcut to knowing where to put your capital next year and maybe where not to, this is your mission brief. Let's start with the basics because the terminology, it really matters here. When we talk about labor productivity, we're talking about real output per hour worked.
Right, and that's not just a guess. It's a very careful calculation, combining BEA output data with...
The Bureau of Labor Statistics hours data, the BLS.
Exactly, the BLS. And this number is so critical because it's the clearest link we have to living standards, to wage growth, GDP, even tiny shifts. We're talking tenths of a percent. They compound into just a completely different reality over a decade.
And that compounding is why the recent data is so interesting and maybe a little confusing.
It's why we have to pay such close attention. I mean, if you look at the U.S. non-farm business sector, the numbers have been, well, they've been eye-catching. We saw a surge averaging roughly 3.6% across the last 3 quarters of 2023.
A 3.6% annualized growth rate is fantastic. But you have to be a realist. That's way higher than the long-run trend, which is closer to what, 1.3%?
Exactly. So that 3.6% is the signal we're all trying to figure out. Is it a blip? Or is it a real sustained shift?
And that's where the caution comes in.
Right. This is where we need to be careful. Researchers using these pretty sophisticated regime-switching models, they've pegged the chance of the U.S. entering a sustained high-growth phase.
Meaning that 3.0% we used to see.
Meaning that 3.0% regime, they've put the chance at only about 40 to 41%.
Only 40%.
Okay.
So that puts us squarely in the realm of what, guarded optimism? It's meaningful, but it is definitely not a sure thing.
It forces you to plan with sophistication. And look, our mission here is to help you distinguish those durable gains, the signal, from the short-term noise. So you can align your time, your budget, your talent with that potential long-run goal.
Okay, let's unpack that signal a little more. A 40% probability. That feels compelling enough to maybe start thinking differently about capital allocation. But why isn't it higher? And why do we have to be so patient?
Well, history tells us these big shifts are really only confirmed in retrospect. I mean, think about the late 90s acceleration.
Right.
It wasn't definitively recognized until about 2 years of solid data had already passed. There's always a lag, and in business, a 2-year planning lag it's enormous.
And it's complicated by the fact that the data itself is a moving target. The sources really stress the impact of data revisions.
Oh, they absolutely can change the picture. A key point here is that the BEA and BLS revisions, like the November 2024 updates, they retroactively raised measured post-2019 growth by about 0.21 percentage points.
So a tiny correction, 0.21 points, which is completely outside of a business leader's control, is a primary driver, shifting the needle from, say, 25% to 40%.
Precisely. And that's why we have to talk about revision-aware metrics. You just can't anchor a multi-million-dollar decision to a single brand new quarterly number. You have to bake that uncertainty right into your framework.
That makes perfect sense. Okay, let's pivot to the recent past then, the 2020 to 2024 spikes. A lot of people saw this productivity boom during the pandemic and thought, this is it. We've made a permanent leap. But the sources say not so fast.
Yeah, it was more of a short-term efficiency bubble, really. It was driven by some very unique circumstances that, well, they've faded now. If you break that surge down, there were 3 main factors. First, labor composition. Early in the pandemic, layoffs often meant companies kept their most experienced workers. So the average productivity of who was left went up.
So it wasn't that the remaining workers suddenly got 3 times faster. It's just that the average experience level in the pool was higher.
Exactly right. Second, capital deepening. You had fewer workers using the same amount of IT, the same machinery. So the capital per hour work just shot up mathematically.
Okay.
And the third piece was a spike in total factor productivity, TFP, which was really about higher work intensity and just efficiency gains born of necessity.
So the lesson for our listener is that those gains, which looked amazing on paper, were non-recurring. They came from shrinking operations, not from a durable tech breakthrough.
That is the crucial takeaway. Those cyclical gains faded as hiring returned to normal. So when you set your 2026 targets, you have to strip that temporary stuff out. If you assume the pandemic spike is the new normal, you're going to significantly miss your 2026 forecast.
And that structural reality leads right into another problem, right? The mismeasurement issue, especially with intangible assets like software.
It's a huge issue. It's hiding in how we measure non-traditional capital. These intangible assets, think software upgrades, internal data platforms, knowledge systems, they don't have a clear price tag in the national accounts.
So if a company invests millions customizing a workflow system, that might not show up as capital deepening the same way a new robot on a factory floor does.
Exactly. So your measured productivity gains could be lagging the real per-hour output gains. The benefit is there, it's just not being counted, which, means that 40% chance we talked about might even be a little understated.
So that makes it even more important for businesses to create their own internal measures. Which brings us to the practical pathways. Let's move from the macro theory to the strategic plan. Given all these risks, the cyclical trap, the mismeasurement, how do we actually make durable, controllable gains in 2026?
We have to cut through the hype. Real leverage comes from matching the right technology to clear workflows and concrete capital investments. The tech has to enable the process, not just get bolted on.
Speaking of hype, generative AI, the excitement in the market is just off the charts. It should be a huge productivity jump, right? But the source material is very cautious.
It is. I mean, Gen AI is great at speeding up drafting, summarizing routine code, but the Acemoglu-style estimates for its durable lift to broad labor output are actually pretty small at first. We might only be talking about a zero point 0.1 percentage point annual bump.
Wait, 0.1%? That seems incredibly low given the billions being invested. Is that just conservative, or is the idea that Gen AI helps individuals but isn't yet transforming the whole economy?
It's more the latter. It benefits certain high-skill workers, certain tasks, but for it to move the national needle, that diffusion takes time, retraining, and a ton of supporting investment. So for now, the strategic focus has to be on proven levers.
Like what?
Like capital deepening in traditional ways and, critically, robotic process automation, RPA, combined with serious workflow redesign. You prioritize high-frequency tasks with clear SOPs. That's where the immediate measurable leverage is.
That's the perfect transition to the 4 key actionable tools the source identifies for 2026. Let's walk through them, maybe starting with AI Copilots.
Right, copilots. Essential for acceleration, for research, code, customer responses. But here's the friction point we see all the time. Companies just install them and tell employees to go play.
And the output is a mess.
It's wildly inconsistent. So the strategy isn't buying the software, it's enforcing standards. You have to develop standardized prompts and playbooks to turn it from a fun toy into a strategic asset.
Okay, tool number 2, workflow orchestration and no or low-code automation.
This is about reclaiming hours and cutting manual errors. But the source mentions a crucial first step that everyone skips.
Which is?
Mapping the process first. If you automate a broken process, you just get faster chaos. You have to make the process lean before you automate it.
A powerful lesson. Okay, tool 3 is robust knowledge systems and retrieval.
This is such a silent productivity killer. People spend, 10 to 15 hours a week just hunting for documents. It's crazy.
I believe it.
Centralizing documents with retrieval-augmented search is huge. It speeds up decisions, reduces that reliance on just asking the one person who knows where something is. You lower the friction, you raise the output per hour. Simple as that.
And finally, number 4, meeting and time compression. This sounds obvious, but I feel like the discipline is the hard part.
It delivers massive, immediate gains, but only if it's adopted across the board. You have to mandate async updates, share docs for pre-reads, and you have to religiously protect focus time. And you have to train people how to do it, not just tell them to.
Implementation is everything.
Yeah.
So now that we have these 4 pathways, copilots, orchestration, retrieval, and compression, we have to talk about measurement. We need to get away from vanity metric.
Absolutely. The North Star metric has to be output per hour worked. And if full factor accounting is too hard, you use simpler proxies like throughput per labor unit. But you anchor it to clear quarterly baselines.
But how do you simplify that for a company that doesn't have a massive data science team?
You instrument your workflows. You standardize your past tags. You timestamp everything. Track the handoffs between the copilot and the human. It turns these abstract ideas into clear, measurable data.
And circling back to our first problem, the data revisions from the BEA and BLS. How does a company really become revision aware when setting a budget?
It's the cost of admission for strategic planning. You use confidence bands, you don't scale a huge investment based on one great quarter, you wait for the second or third revision to confirm that the signal is real, treat the first reading as a possibility, not a guarantee.
That's sophisticated advice. It takes a lot of discipline.
It does, but it separates the reactive businesses from the strategic ones.
Okay, let's bring this all home. Based on everything, the 40% signal, the cyclical traps, the 4 tools, what is the strategic approach you want our listener to take into 2026?
Plan with guarded optimism. Treat that 40% signal as a high priority thing to watch, not an assurance. Focus your effort entirely on what you can control. Capital allocation for workflow redesign, enforcing tool standards, and targeted training.
So, stage deployment. Get some quick wins this year with copilots and fixing broken processes while you use that measured capital deepening to build the foundation for those compounding gains in 2026.
That's the path. Continuous measured improvement. That's how you get to that 3.0% trend, no matter what the macro noise is doing. And just before we wrap, I want to add one more thing. We've been very US focused, but cross-country data shows a shared long-run productivity slowdown globally.
Common downward path.
A very common path, steeper in Europe. Principal component analysis shows a single shared factor explaining a huge part of the variance. It points to systemic global forces at play.
Global constraints.
Exactly. So the provocative thought I want to leave you with is this. Since these global forces are a major constraint, how does that reality affect your ambition? How should it affect the benchmarking for your capital investments? Even when local U.S. data looks strong, if the whole system is slowing, what does that mean for your long-term goals?
That is a perfect question to end on. A real strategic challenge to think about. Thank you for joining us on this deep dive. We really hope you found those actionable steps, standardized copilots, pre-mapped orchestration, and those revision-aware KPIs essential for your planning. We explicitly thank you for tuning in to the SmartKeys podcast. If you want to get into all the statistical weeds, the full article is an excellent resource, and the link is right there in the show notes. Please make sure to subscribe to the SmartKeys podcast for more deep dives that help you separate the signal from the noise. We'll catch you on the next one.